Hi friends, in today's video we're going to see about trading. It's one of the largest markets around the globe and even in India. And why not understand about trading so that we can maximize our gains out of trading. The normal platform which we are aware about trading is the cash and carry segment, but we are not aware about the other segment of wherein you can trade and maximize in this particular other platform. So what is this other platform? We are going to see that, and what are the different products available in this other platform. We are also going to see in this particular video, provided that you are able to speculate in the market to a great degree of efficiency. That means you have an efficiency of 80% and above, then you can use these other platforms of trading so that you can maximize your gains. So please share it to your friends and other members as well, as many people as possible, so that they can also understand if they are great speculators, if they are able to predict the direction of the market or predict the direction of a particular stock, then they can use this particular other segment to their advantage so that they can maximize their profits. So let us see what are the options available and what is the best option available in case of trading so that you can maximize your gains. So one of the platform available is the cash and carry segment, which is your normal segment where you can buy stocks in and day out, and you can keep it invested for a long duration of time. So these typically are investors, but even traders enter the cash and carry segment so that they can buy a particular stock. Let's say Hindustan Unilever stock, they buy it for about 2,600 in the current context, and then want to sell it. We have an intention to sell it for about say 3,000 in the short span of time, let's say about 3 months or 6 months visibility, they want to sell it for 3,000. So because of this difference, they get an advantage, they get a gain of about 300 rupees. On this 300, they again have to pay capital gain tax. If they've sold it for lesser than 1 year, they have to pay capital gain tax of related to short-term capital gain tax. And if it is beyond 1 year, then they have to pay capital gain tax related to long-term capital gain tax. But nevertheless, for long-term capital gain tax, up to 1 lakh of capital gain is tax exempted. But if you realize, depending on your investment and the profit whichever you have gained, the percentage of profit over your investment is okay to a degree extent, probably fine with a particular person who is trading in the cash and carry segment. Depends on his risk appetite as well. But in this other segment, which I'm going to talk to you about now, that can maximize your gains. That means you can do even a lesser investment. That means compared to 2,600, you might be required only to pay a margin amount of say 10% in this particular other segment. This other segment is called as the F&O segment, future and option segment. Most of you might be aware, some of you may not be aware. But let us see how you can make use of the future and options market so that you can maximize from your trading expertise. So in this particular video, we are going to say only about options, and future markets we are going to take up later. So with respect to options market, you have two products. That means you have a call option and you have a put option. But before you understand call and put option, we understand one aspect, that in the options market, you only have to put a percentage of margin you can invest in the particular underlying asset and still get a benefit of a sizable amount of shares of the particular company. You have to buy it in terms of lots. So that means HUL, which is available for 2,600, you might have to pay just 26 rupees per share, but you might have to buy more than one share, let's say like 10 or maybe 15 shares of HUL. So, but your investment for buying more shares is lesser compared to if you buy from the cash and carry segment. So that is one aspect which you need to keep in mind in the case of an options market. So with this specific two types of product, with this call and the put option, let us understand the call option and how can one make use of the call option to benefit from trading. So let us see the concept behind the call option. Now you have this call option which is available in the market, in the future and options market, and it has a specified expiry for the particular option. Now in the stock market brings in sellers and buyers. Obviously in the options market as well, there should be a seller so that somebody can buy the particular option. So the seller sells the buy option and the buyer buys the call option at a particular strike price. This is a technical term, strike price, but this is the price wherein these two parties, the buyer and the seller, have come to a committed strike price in a future date. That means the seller, what he will do, because he's selling the particular option in the future and the buyer is buying the option in the future, the buyer has the right to exercise his particular commitment in the future and be able to buy it still at that particular strike price, and the seller has the obligation to sell it. So let us see in case of HUL. Let us say I as a trader, I'm bullish about HUL. So what I do is I buy a call option of Hindustan Unilever. So my loss is limited to the option premium, and the gain to the seller is limited to the option premium. But the profit, my profit, because I bought a call option, is unlimited, because I don't know whether stock price will reach, and the loss to the seller is unlimited depending on the price of the stock. So let us see in case of HUL what happens down the line. Let's say down the line, 3 months down the line, HUL stock, which I had bought it earlier 3 months today, 3 months ahead, I bought it for 2000 by paying option premium for 2600 strike price in the future, and the market price in the future of HUL turns out to be higher, let's say about 3000. So as a buyer, always as a buyer, I always want to buy it at a discount. But nevertheless, if I don't want to exercise my right, I can still take the benefit of a higher price, of a higher price in the market, because the underlying has increased in value. I can still sell it before the expiry without exercising my right. But if I want to exercise my right as well, so let's say I exercise my right, I still have the option to buy the particular asset for 2600 compared to the current market price of 3000. Still the buyer is at a gain. His loss is only limited to the premium. He will not get his premium back, but his advantage is that he bought the underlying asset for 2600 of HUL compared to 3000 today's market price. Because he may not have cash today, he'll have cash 3 months down the line, so he can buy the option premium and then stay invested in HUL. But the seller gets the profit of the premium, but because the market price of HUL is now like 3000, he has to buy for 3000 and then sell it to the buyer of the call option for 2600. So that's a loss to the seller. So let us see the other option, that is called as the put option. Now, even in the case of put option, you have a buyer and seller, obviously, and when you say put, when a buyer buys a put, his intention is to sell the particular underlying asset, and when a seller is selling the put, his intention is to buy the underlying asset. So as we have seen in case of a call option, the buyer of any underlying asset, the buyer of the particular premium, always has the right, but the seller always has the obligation. In this particular case, put option, the buyer has the right to sell his assets of the underlying, and the seller of the put option has the obligation to buy it upon expiry if the buyer exercises his right. So let us say in case of Hindustan Unilever, I bought it at a strike, I bought a put option at a strike price of 2600, okay, 2600 in future. I bought this put option, and in future, 3 months down the line, HUL, Hindustan Unilever, drops in price to about 2000. Now, as a buyer of a put option, I have the right, I can exercise my right and still sell it for 2600, even though the price has dropped for 2000. But the seller of the put option has the obligation to buy it for 2600, even though the strike price, even though the current price is available for lesser. So this is the way you can use the options market, the derivative market, that is the option market, to benefit depending on the view or prediction on the market, whether either you're bullish or you're bearish. So use these two options to your benefit. If you're bullish, buy call. and if you're bearish, buy put. So this is the view, this is your hedging strategy if you are bullish or bearish. But nevertheless, it is for speculators and traders, and it can, you as an investor also could use it to your advantage, as I've explained already, to buy stocks. If you don't have cash today, you can buy stocks in the future when you have cash available, for that particular price which you have identified today. That may be the intrinsic value today, and in future you are still having capability to buy it at that particular intrinsic value if you don't have cash today. So that's the way, and you could even hedge your positions. For example, if you are bearish about the market, you could buy put options, and even though your portfolio value slips down, because you have put options, you can gain because the put option value has increased. So this is the way of how you can make the most out of the derivative segment, specifically the options market. So hope you have enjoyed this video, and please subscribe, please share it as well, and see you in my next video, wherein I will cover up various topics related to investing so that you can get the maximum benefit.